Hello, my name is Richard and I'm the lead developer at AlgorithmicTrading.net. In this video I'm going to be reviewing our design methodology and how we use market directional pseudo arbitrage to put together portfolios that are designed to do well in both up, down, and sideways moving markets. Okay, so first I would like to go over our disclaimer. We are not registered with the CFTC as a commodity trading advisor. We are what's called a third-party developer. We create algorithms and we license them for use on a personal computer through TradeStation, and they can also be auto-executed through NFA-registered brokers. Keep in mind that trading futures and options involves substantial risk of loss. These algorithms are really not for everyone. They should be traded with risk capital only, in our opinion. And lastly, the data that we show, unless otherwise noted, is based on hypothetical back-tested models, and it does have certain limitations per the disclaimer here. So feel free to read this. You can pause the video and read it more carefully. The last comment I'll make is that the data is for educational purposes only. Again, because we're not registered, we do not control client accounts. And also, I guess I should mention that because we're not registered, the data that we show has not been audited by any government agencies. So just keep all that in mind as we go through the data in this video. We're going to be talking about performance. Again, that's based on hypothetical back-tested models. It does have limitations. At times we do mention the live returns on the website or in the video, and when we do, that is from live data and we note it as such. When we do that, just again keep in mind that past performance is not indicative of future results, and again, trading futures does involve risk of loss and is not for everyone. Okay, so now I'll start talking about our design methodology, but first I'd like to just comment on predicting market direction and trading algorithms in general. So obviously, no one can predict the market direction with 100% certainty. There's no such thing as a holy grail trading algorithm. There's always give and take. If you have an algorithm that aggressively buys the S&P, more than likely it's going to do well when the market's going higher, obviously. The hard part is that as the market trades sideways or gets volatile or starts trading lower, that algorithm that does good when the market goes higher will take losses as the market rolls over and trades sideways, getting stopped out of trades. So the more aggressive an algorithm is in trying to capture those gains, usually the more likely it is to take losses because it will be getting into trades that might be a little bit more risky and then get stopped out of those. Another example would be if the market's going sideways, you could obviously just short the top of the range and then buy the bottom of the range and keep doing that. The problem is that when the market breaks out or out of that range, then you'll get stopped out of those trades. Or if it sells off, then you'll get stopped out of the long trades that you take towards the bottom of the range. So that's just in general the problem that any algorithm developer faces. So you want to try to capture the gains when it goes higher, capture gains when it goes sideways, and then capture gains when the market goes lower. So if you knew 100% certainty the market was going higher in 30 days from now, if you had a crystal ball, then obviously you could load up on the S&P and then just sell after 30 days. But the problem is no one knows with 100% certainty. So with that said, I'd like to move on to the next slide. So at AlgorithmicTrading.net, we do feel that we have a better way. Instead of creating a single algorithm that does good in all market conditions, what we do, and this is really the core of our principle at AlgorithmicTrading.net, is that we use a market direction pseudo arbitrage algorithm. And so what that means is that we attempt to be market direction agnostic by implementing a pseudo arbitrage technique. It's not 100% arbitrage because it's not a 100% paired trade where we're equally long or equally short the indexes. It's more of a design that would overlay multiple trading strategies into one complete system. So what we do is we create multiple algorithms that trade together as part of a portfolio. We attempt to have 1 to 2 algorithms outperform in up markets, 1 to 2 that would outperform in down markets, and then 1 to 2 that would outperform in a sideways moving market. The key and the real R&D effort when you do this kind of technique is trying to make sure that these hero algorithms don't lose too much in contrary market conditions. Either they go on the sideline, or they take small stops, or even potentially have small gains. But that's really where the brunt of the effort lies, in our opinion, is to create these algorithms that do good in certain market conditions and then don't lose too much during contrary. Because what happens is when you overlay all these algorithms together, then you have a complete system that's doing its best to outperform no matter what the market conditions are. Alright, so the first step in implementing our trading methodology, our design methodology, is to define market state. So we need some way of comparing each one of our strategies to how it does based on if the market's going up, down, or sideways. The way we did that is we took our back-tested period, which the one we did most recently was from October 2003 to October 2016, which has about 163 total months. And what we wanted to do was to categorize each month of the S&P into 3 equally distributed states, either strong up, sideways, / drifting, or down. Again, the market can trade higher, lower, or within a range for any given time period analyzed. So someone could do this on a 1-minute chart and analyze each 1-minute candle as its own kind of performance state. You could do it on days, you could do it on months, I guess you could even do it on years. We chose to do it on a monthly basis because we felt that that would give enough room to see how the strategy traded throughout that period. So again, we define the market states into 3 categories. The market is either going up, it's either going sideways, or drifting higher or down. So to kind of show you what I mean, let me pull up a chart of the S&P 500. So this is the E-mini S&Ps. So essentially the S&P 500 on a monthly chart. So each one of these candles is 1 month. So for example, right here is October, where the market traded down in October of this year. Here's another down month in 08. So you can see 08 here when we had that bear market. And if I kind of zoom out and go sideways, you'll see every month since 03 on this chart. So what we wanted to do was create 3 categories so that we could compare our strategies to each category to see how they do. One way to do it was we could have just said, well, if it's a green candle, that's an up month, and if it's a red candle, that's a down month. But we wanted to characterize the kind of in-between sideways moving conditions where there's either a lot of volatility, the market goes up and down within that month, but then ends up trading very close to where it started. And so the way we did that is we partitioned each month into a category. So strong up, we define that as the S&P closes higher by 30 points or more, which would be roughly about 1.5%, maybe 1% in some of the earlier months in our period. And what that equals on the S&P E-minis is a gain of more than $1,500. So if somebody bought the S&P that month and then sold at the end of the month, they would have made $1,500 or more. And so that's how we characterize a strong up month. In the history of the 2003 to 2016, there were 55 months in that category. The other category that we did was down. So if the S&P closed down by 4 points or more, which would be a loss of $200 or more, we categorize that as a down month, and there were 55 of those. So then kind of this in-between state is we called sideways / drift higher, because it's really sideways or maybe up a little bit. And so that's the in-between category that we call sideways, where the S&P would have either been down between 4 points or up 30 points, anything in between there. So either a loss of $200 or a gain of up to $1,500. And so there were 53 of those months. And so you can see that we created these values in order to have 3 equally distributed states, because we didn't want any one state to be over-representative of that period. So that's how we defined our 3 market states. The next thing that we do is we compare how each one of our algorithms does in each of the market conditions that we've defined. Now, what I'd like to do is quickly show you a chart of our S&P Crusher package. This is the portfolio that trades all 7 of the algorithms that we currently trade. And so what you're looking at here is our momentum plus the covered calls strategy. This one here is the Iron Condor. It trades the S&P E-minis. This one also trades the S&P E-minis. This one is the 10-year note treasury algorithm. This one trades the 10-year, and usually when the market goes lower, when the S&P goes lower, the 10-year normally will go higher. It doesn't always, but normally it will go higher. And so this, by going long the 10-year, it's very similar to going short the S&P, although it's not 100%. It doesn't always do that, so just keep that in mind. This algorithm here is our gap short algorithm. It's a newer one that we recently added. This one is our breakout day trade algorithm. This one is our short day trade algorithm. So these 3 are day trades. This one is our 10-year note treasury algorithm. This is our Iron Condor options algorithm, and then this is the momentum plus the covered calls algorithm. So what we did is we take each one of those 7 algorithms, and we call those strategies. So on the website you'll see each one of those partitioned on the website as a trading strategy. These are the kind of discrete strategies where each one has a different expectation of performance based on either an up moving market, a sideways, or a down. And again, up is it closes up by 30 points or more for that month. Sideways, the S&P closed between down 4 points and up 30 points, and then down is a loss of 4 points or more. So what this shows is if you take the strategy, and we'll take the momentum first. That's the bullfire we used to call it, but we changed the name to the momentum. This one is the algorithm that we have that does best when the market goes higher. And you can see that when we took the monthly back-tested performance of the momentum algorithm and we lined it up against any S&P month that closed up by more than 30 points, the average gain for this algorithm is $1,600, and that a unit size, if someone was just trading the momentum algorithm, would be something around $20,000. So this is a gain of about $1,600 in the month per 20,000 traded. Again, this is trading one contract, and even though it says 1,600 here, this is the average over all the up months, and I believe there were 55 of them. We averaged $1,600 gain in the back testing for each one of those months. And what's really interesting is if you then look at how this algorithm does in a sideways moving market, you'll see the performance drops off quite a bit. It's only up $378 for that month. And again, this might represent 10 trades in that month. It just depends. Each one has a different average. And then again, when you go to a down month, this momentum algorithm does not do well. It actually loses $812 per month on average. So again, this is the example of if we knew that the S&P was going to be up for that month, if we had the crystal ball, all we would do is just turn on the momentum algorithm and shut off all the other algorithms and just put everything in this. The problem is, though, is that no one knows with 100% certainty. I'd like to also just look at this algorithm and kind of show you the example. So this is the momentum algorithm. Again, this is the one that does good when the market goes higher. And if you look here, this is the algorithm is basically applied to the S&P 500. That's this top chart. This bottom one is the VIX, and it's in this chart because the covered call algorithm uses it. But what you'll see is that as the market goes higher, this momentum algorithm starts getting in. So you can see here we bought on the 9th of November at 2158.75, and then we got out 2 days later at 2165.5. So this is a gain. Anytime you see the blue dotted line like this, that's a gain. And so as the market was going higher, we had a winner right here, another winner here, another winner here, and then another winner here that we closed out yesterday. And then Friday at the close, we got back in on this algorithm. And so as the market goes higher, we had 1, 2, 3, 4 winning trades in a row. And that's to be expected because this is our long biased algorithm that should do well when the market goes higher. Now what you'll see, though, is that as the market was going sideways through here, we did have a few winners, and I'll zoom in on that so you can kind of see. It's like I jumped past it. So right in here, as the market was going sideways, we didn't have any trades. So the algo really did the right thing by shutting off through October in here. Then it got back in right here on the 6th of October. It got out when it hit its target the next day. Jumped right back in on the 7th, hit its target on this big gap up. And it got back in on the 10th and then got stopped out. Jumped right back in on the 11th and got stopped out again. So you can see as the market was going sideways, it did kind of okay, but then as the market rolled over, it got stopped out. And so that gives you an idea of how at least this algorithm that's designed to do well when the market goes higher, how it does. So when the market goes higher, we generally speaking are going to expect this algorithm to do well. Now it's not 100%. I believe it's of those 55 months where the S&P closed up by 30 points or more, I believe this algorithm is 85% profitable. So 15% of the time it gets those conditions wrong and was at a loss. But here's another sequence of trades from back in July of this year, where as the market went higher, we had 1, 2, 3, 4, 5, 6, 7 winning trades in a row. Then we got stopped out. Then we had another 1, 2, 3, 4, 5, 6, 7, about another 6 winners before taking another loss. And that's okay. Again, we don't expect this algorithm to work 100% of the time in all market conditions. This is what we call our hero algorithm for the condition where the market is going higher. So again, that's the momentum algorithm. It averages 1,600 per month backtesting when the S&P is up. It averages 378 per month when the S&P goes sideways backtested, but then it's at a loss on a down month. Now I'm going to quickly go over the other ones now that I've shown that example, but the Iron Condor also does really well when the market goes higher. And an Iron Condor, essentially it's selling a call and selling a put at the same time. And so what it's doing is creating a kind of a bracketed range that we want the S&P to close at for that week. But the Iron Condor actually does really good when the market's going higher, even though it's selling calls. And the reason why is because the calls that it sells are deep out of the money, and the puts are as well. So it does good when the market's going higher. When the market goes sideways, it does really good as well. And you'll see that in sideways conditions, this algorithm does the best. And that makes sense. An Iron Condor is a trade where you're expecting the market to go sideways. That's why people place the Iron Condor trade. So as long as it closes between our two strike prices, it's a full profit trade. Now when the market is going down, the S&P closes for that month 4 points or more, this algorithm averages a loss of 195. Let's look now at the day trade. That's another algorithm, this breakout day trade, that does good when the market goes higher. It's also barely profitable in sideways. If we really don't count that as doing well sideways, but at least it doesn't lose money. And believe it or not, it actually does not lose money really in down markets either, and that's because it's buying strength in the morning for a day trade. And so in down markets, this breakout algorithm just doesn't really trade that often, and when it does, it can capture some pretty big short covering rallies, but then it gets out that same day. Let's look at the covered calls now. So the covered call also does the best during sideways market conditions, but it also does good when the market's going lower. The reason why it does better in sideways is only because it places more trades. When the market's going sideways, it's selling calls that are tied to the momentum algorithm, and so as the momentum algorithm gets into a trade, it'll sell a call for that week, and that's why the numbers 523 is higher than when the market's going down. It's only because it places more trades, but it also does good when the market goes down, and that should be real obvious because we're selling calls, and then the market closes lower for that month. More than likely, those are going to be profitable trades. This breakdown short day trade is similar to the breakout day trade, but it goes short. So it shorts into market weakness for a day trade, and it does its best when the market is going lower. So this also makes sense. It's going short, so of course it'll do better when the market goes lower. It's kind of interesting. It also does pretty good in sideways market conditions, and then this is not a surprise that when the market's going higher, it is at an average loss for the month. One comment on this is that when the market is going higher, it's pretty rare that the short day trade will fire, because it requires market weakness for it to get into the trade. But when it does and the market is going higher, it's more than likely going to be at a loss. So then the gap short day trade is another day trade algorithm, does best when the market's going lower. This one shorts morning gaps and then has a target, and so it's actually a newer algorithm, but it helps out in the down market conditions and also in the sideways market conditions. And then when the market's going higher, it really just doesn't, it's just kind of average, doesn't trade a lot, and when it does, it's probably half winners, half losers. All right, so the Treasury note algorithm, that's the we used to call it the push-pull, but it trades the 10-year. This is our best algorithm for down market conditions. So again, in the back testing from October 03 to October 2016, this algorithm averages about $1,000 per month when the S&P closes lower, and that's also to be expected. Again, this Treasury note usually rallies when the S&P is going lower, and so it's a swing trade that we take, and that's why it does good when the market goes lower. It also does good in sideways market conditions. Actually really good in sideways. It's the third best algorithm we have for sideways, and I think it's mainly because as the market's going sideways after going higher, we start getting into the Treasury note trade. And then as the market starts rolling over, going sideways, a lot of times the 10-year will begin to rally, and so that's why it will have gains. When the market's going higher, the Treasury note doesn't do that good. It still averages $48 per month, but that's pretty much flat. So it might have a winning trade here and there, or it might just be on the sideline. But so to summarize this slide, after we've defined the market states of what an up, down, or sideways market is, and again, we wanted them equally partitioned into 3 categories so that they weren't weighted too heavily to one side. This shows how each algorithm does for those market conditions. The next slide, I'm going to show you how we put that together in a portfolio, and you can probably begin to imagine how it works. But basically what we do is we look at, okay, this algorithm does good in up conditions, and so we want to have an algorithm like this so that we're covered when the market goes higher. The Treasury note does good when the market goes down, doesn't lose a lot when the market's going higher. And so as we overlay all these algorithms together, you can start seeing how we have this pseudo arbitrage slash market direction agnostic portfolio of algorithms. Okay, so in this final step, what we do is we assemble the algorithms into a portfolio. What you're looking at here is, again, this is based on the back-tested models, but this is the S&P Crusher V2. It trades the iron condor, the momentum, the breakout day trade, the covered call, the breakdown short, the morning gap, and the Treasury note. So the Crusher is a collection of these 7 algorithms. And what I've done is just copied the values from here into a new slide just to show the totals. So when you sum up everything, it gives us an idea of how we expect this algorithm to perform based on what the market is doing. So the total is, when you add all these 7 algorithms together, it's about 3,541, and that's per $30,000 traded. So our kind of general expectation is that if the market's going higher and closes up by 30 points or more, we expect the Crusher to do really well, and that's primarily because of the momentum algorithm and also the iron condor, but the other ones also contribute. The only one that doesn't contribute is the short day trade, which actually does have a average of losses during up conditions. And then we look at sideways market conditions. So when the market is going sideways for a month, we expect the iron condor to do really well, on average to make about $1,000 in that month. The covered calls to also do well, and then the Treasury note to do well. So when you sum these together, you're at 2,661, and on a 30K account, so that's just shy of about 10% on a sideways moving market. When the market goes lower, this algorithm still does really well. It averages 751, which is about a 3%. I believe that's about about 2.5% for the month, and that's mainly because of the Treasury note algorithm. You'll see that the momentum algorithm cuts into some of the gains that we would have seen, and so one question that we look at is, do we really want to have the momentum algorithm in any package if it takes these kind of losses during down market conditions? It's our opinion that the answer is yes, because it does so well in up conditions, and also in sideways. So that's kind of how we put together these portfolios. So the S&P Crusher has very high expectations for up and sideways market conditions, and also high expectations for down conditions as well. Again, keep in mind this is based on the back testing. This doesn't mean that we guarantee that every month these algorithms make money. They don't. We have losing months. This is just the average based on the back testing, and it's also how we track the performance in the live trading to see how they match up with these expectations that we have. This next slide is looking at the same data, just in a little bit different way. It's using this kind of stacked column chart or bar chart, and what we've done is we have each algorithm a different color, and then we have it categorized in the strong up, sideways, or down. And what you can see is that just another way of looking at the same data. So when the market's going higher, the iron condor contributes a lot, the momentum contributes a lot, these other ones contribute a little bit, the breakout day trade does well. When the market goes sideways, you can see the iron condor also helps, and then when the market goes lower, the Treasury note does the best. These other ones help out, but then we do lose some on the because of the momentum algorithm right here. So this is our S&P Crusher. It is our flagship portfolio. It's designed to do well in all market conditions, and we do feel that this is our best package. It requires about $30,000 to trade it, and that's based that's based on what the brokers require. In theory, someone could actually trade it with less, and so that $30,000 is just a starting account. It can take a drawdown of I believe over 50% before it would have to turn off any of these algorithms. There's plenty of buffer built into it, but that's kind of our case study of our S&P Crusher, where we use this kind of market direction agnostic design methodology to put together a portfolio that we have high expectations for moving forward. Okay, I'm going to quickly go through the other portfolios that we have. This one's the ESTY Futures V2 portfolio. This algorithm is very similar to the Crusher, only we took out the Iron Condor. So it trades still the momentum, the breakout, the covered call, the short day trade, the morning gap, and the Treasury note. Because it requires only $20,000 in the account, it does have a slightly better performance on a percentage basis during down market conditions. It's about 5% per month as opposed to 2.5% on the Crusher. So this is a great package for someone that maybe wants to be a little more focused on a potential bear market that might be coming. But you can see that it still does really good in up market conditions and really good in sideways as well. This is kind of a similar case study picture that we had on the other slide, only with the ESTY futures, and so just another way to look at the data. The momentum once again helps out in the bull, takes away some in the bear market conditions, but then these other algorithms kind of make up for those losses so that we still have a really high expectation for it. The day trader is a portfolio that we put together mainly because there are some people that do not want to hold positions overnight or over the weekend, and they don't want to do options trades. So this is only the day trade algorithms. The unit size on this one is $10,000, so each unit traded is 10K. You can see that the amount that this one is expected to make is lower than the others, so you're at about 3% for an up market condition. But it does do really well in down, and so this package really would be for someone that just really doesn't want to hold any positions overnight, and because when you do hold positions overnight, there is always a little bit of extra risk due to geopolitical events that might happen, overseas markets that could impact the U.S. markets. So because it's a day trade, we're in and out the same day. Most of these algorithms have pretty tight stops. And so they'll get in usually in the morning and then either get out at the close the same day or when they hit their target or stopped out. Again, this is a similar way to look at this data where you have the strong up, the sideways, and down. And so I'll quickly go through this one. This last one, we call it the bearish trader portfolio. And really what we did is we just took the 4 algorithms that did the best in bear market conditions or down markets, and we put them into a single portfolio. Even though this, I know most people are bearish right now in the markets, and if someone asked my opinion, I would probably agree. So I know there's probably a temptation for people to gravitate towards this portfolio, and we can't give advice. All we can do is show data. But I do want to caution people that this portfolio in up market conditions is really not, we really don't expect it to do very well because it doesn't really have a hero algorithm for the up condition. It does still have good algorithms for sideways and has really good ones for down. But this portfolio is out there just in case someone doesn't mind taking that risk trade-off on the up market condition. Just really they want to just be hedged for potential downside. So this is the data for the bearish trader portfolio. And then if we look at this chart, again, as you would expect, this looks really good on the down, looks pretty good on the sideways, and then strong up though is not that great. So I think that covers how we put together portfolios. I think one other thing I want to comment on is we are talking about design methodology here, and so really what I'm not talking about is how we create the strategies. When we, what we're showing is what we already have, the strategies that we've had that have been under development for the last 3 years. Some of them have traded live already for well over a year. But there are a lot of strategies that we develop that we don't put out to the public because they don't pass all of our tests. So the 7 strategies that we have that I showed on this first slide, these are the 7 strategies that have passed our design requirements, and once it passes our design requirements, that's when we put it in a Excel spreadsheet like this to see, okay, how does it help out in up, down, or sideways. This is really showing our kind of 10,000 foot view on how we go about algorithmic trading. So we don't try to create one algorithm that does good at all times. We create multiple strategies with each one having an expectation based on what the market might be doing. So now I'm going to be talking about some optional kind of good practices that we use. So what this is just kind of a graphic showing some of the design criteria that we use. When you put together a trading strategy, the biggest risk is that it's over-optimized. The way that we try to fight that or do our best to ensure that the live returns will continue on the path of the backtested hypothetical is we'll do things such as backtest as far back as possible, minimum 10 years. In a portfolio, we want to have multiple uncorrelated algorithms. We want to have reasonable profit factors, so anything between 1.2 and 2.6 in our opinion is good. Some people are looking for profit factors bigger than 2, 3, 4, 5, 10 even. In our opinion, I'm just not sure that those really exist in live trading. I have coded algorithms that have profit factors of 20 and higher, but you pretty quickly realize that those are over-optimized and that they're just not practical. So we like to, instead of trying to create that holy grail, we try to get real more simple algorithms that have reasonable profit factors, and then as we overlay them on top of each other, we create that more kind of robust trading system. We like to see large average gain per trade. We don't like scalping day trade algorithms. I have coded algorithms before that trade on 1-minute candles and have equity curves that go pretty much straight up. But the average gain per trade might be $12, which is the the bid ask on the S&P, and so in our opinion those are not good, and so we look for kind of more bigger average gain per trades. You always want to make sure you use look inside intrabar order generation. That's just something to do with TradeStation where it can, if you don't have this set, it can make assumptions about whether or not a stop was hit first or a limit order was hit first. You definitely want to include slippage and commission. Generally speaking, the fewer the technical indicators used in the strategy, the better. We like to see 3 or less. One reason why we mention this is because if you have a trading strategy that uses one technical indicator, that's ideal, because that means that you have a good algorithm that only looks at basically one indicator. Really, the only reason why people would have more than one is because when they had one, it didn't work. So they might add a second so that they can get rid of some of the gains or the losses in the back testing, and so they keep overlaying more and more indicators, which really just creates kind of a recipe for over-optimization. If possible, and if it makes sense, we do the Monte Carlo simulation. We don't always do that on every algorithm, though. We like to modify the inputs after we've optimized by plus or minus 10% to ensure that there's minimal impact. We'd like to see 200 trades or more in the back-tested history, and then we like to trade it live prior to offering. The duration of how long we trade it live just depends. It could be as few as 2 weeks, as in the case of the gap short algorithm that we recently launched, or 6 months, as was the case with the momentum algorithm. But we do like to trade it live before we offer it. We want the drawdown to be scalable to meet needs, so we want to make sure that there's a way to lower the drawdown if possible. So instead of trading a $30,000 per unit on the crusher, someone could trade 1 unit per 60,000. That cuts the gains in half and also the drawdown. And then we do not over optimize. So when we do our optimization, and for those that aren't familiar with optimization, we will have another video out that will talk about that in more detail. But we don't want to over optimize, so we optimize on fairly large increments. We do not optimize down to the tick level. And then when possible, independent third-party evaluation. We early on we did have this done on some of our older algorithms. We haven't done this on the more recent ones. And then the last thing is a scalable system that can handle volume. So there's a ton of different futures instruments that can be traded. We like to focus on the ones with the most volume. So the S&P, the 10-year, those really have the most volume, and so we stick to those. All right, so this is the last slide I have, and I just want to kind of review what we talked about. So the purpose of this video was to give everyone a real high-level view of what our trading design methodology is. How do we look at the market? How do we try to outperform it and provide value? As an engineer, we're always trained to solve problems. And when I looked at the market, the reason why I enjoy it is because to me it is one big problem to solve. And there's a lot of different ways to solve this problem of trying to outperform the market or to be profitable with algorithmic trading. Lots of different ways to do it. I'm not arrogant enough to think that my way is the best way or the only way. But I did want to just kind of share the way that I deal with the market. And the way I do that is I just recognize the problem that you just can't predict market direction. I mean, we can make estimates. When the bullfire triggers, we know that the win rate is about 70% on that in the back testing, and in the live trading so far it's for the most part matched that. But we don't know for certainty. There's always that 30% chance that we'll be wrong on that trade. So instead of trying to make that algorithm have a 100% win rate, which is impossible, we create other algorithms to cover these other market conditions, and so that's the approach that we take. So we build a suite of portfolios that have high expectations to perform well in all market conditions, and just want to emphasize that that it doesn't always work that way. I mean, you can have the market go higher, and the bullfire for whatever reason could take losses for that month. So it's not 100% certain, but in our opinion it does stack the odds in our favor for future success. So then once we have a strategy, then we analyze it, we run all the tests on it, we back test it, we do walk forward as well on some of them. I haven't really talked about that. We will in another video though. But we do all kinds of testing to try to break the algorithm, to try to figure out, is there something we're missing on this where in going live it's not going to do as well. And once we feel good about it, then we kind of analyze it, see how it does in up, down, sideways, to see how it can fit into our portfolios. And then there's the various sign-offs that we do prior to offering to the public. Just also want to emphasize that in some cases we don't do all the sign-offs, in particular the Monte Carlo simulation, which is essentially randomizing trades to make sure that there's no hidden patterns that are being missed. We don't do that. One reason is that we don't do it on all of them is because we trade the indexes. There is an ebb and flow to the market where it'll kind of go higher, then sideways, then either roll over or go higher again. And so that's some of the patterns of wins and losses, in our opinion, are built into the market. So we don't always do that. We haven't always had the independent third-party review. But what we do think we have is a really good suite of algorithms. We've been around for about 3 years now. We've kind of every 6 months to a year, we might come up with upgrades, new algorithms that we add into these packages, and we would love to talk to you those. So if you have any interest in what we have to offer, then just give us a call. You can also email us. We have we have people that can do a live demo if you'd like, where they will share the screen, similar to what I have here, and kind of walk through each one of these algorithms to show you, all the performance reports, and to go in more detail. Also on the video page of the website, we'll have more videos where we'll be talking about these strategies in detail. I really enjoy talking about algorithmic trading. As the lead developer, I really enjoy it far more than doing kind of the sales stuff. So I'm hoping to get a lot of videos out there. Hopefully, if anyone out there is a developer and they do their own algorithms, hopefully some of the data that I provided might be helpful to you as well. To think of your algorithms as how they do in different market conditions, and then use that information to try to plug any holes that you might have in your portfolio. But again, would love to talk to you more, answer any questions, provide a quote. Again, trading futures and options involves substantial risk of loss. It's not appropriate for everyone, but for those of you that are active traders or investors that are looking to take advantage of algorithmic trading, we definitely feel that we're kind of a leader in this space, and we're doing our best to provide a quality product to people, and hope to hear from you soon. All right, have a great day. Thanks for watching. Bye-bye.